Good afternoon, everybody. Before I jump in here real quickly, I wanted to address the question about why invest in an emerging manager, because I am an emerging manager. Um, and I'm answering your question specifically, why invest in emerging manager? I'm an emerging manager because my assets are sub 100 million. But I've got a great track record, and it's a long track record. And what I'm offering is something different and unique. And one of the reasons that I haven't grown as big as some of the other managers are, why I'm not a Millennium or Citadel, goes to what the earlier panel was talking about, which is relationships. So all of my LPs have been word of mouth. I think this is the second conference I've done. Both have been with Marty. This is the most outbound marketing I've done. But in talking about my LPs, and the other panels talked about the importance of relationships, one of my LPs just retired. He was the global chairman of investment banking and corporate finance at a bulge bracket firm. We met for 12 years. For 12 years, we had lunch. We talked about my data before he made an allocation. And it's not an overstatement to say some of my other LPs are just as credible on a global basis. So these things take time, and I recognize that as an emerging manager. They take time, they take relationships, and that's why I would encourage you to reach out if you would like to invest. Okay, so I'm going to do a quick presentation on the technology we're using. And I'll go as far as to say it is unique. Let me get this pulled up here.
Do we share screen?
Yeah. Okay. So on my screen, it's showing that okay, full presentation. Great. So I'm going to talk about how we're using technology in our operations and investing. And you'll see from our results that it is differentiated technology. Quick overview, so I'll talk about how we're using operations investing. I'll go through an investment example and then talk about how we're using it in risk management. And so quick credibility statement. This data is, so I started Global Return in 2013. And since we have an 11-year track record of 24.1% net, that's return on invested capital. So it removes the effect of our cash balance. We have what we think is the industry's first algo attestation. And what that is a bulge bracket, or one of the top 3 accounting firms actually is reviewing our documented process procedures and software development code to confirm that the documented process procedures match what we're actually doing. It's actually a lot more extensive than that. You can ask me for more questions. You can ask questions afterwards. And then our technology is custom built. So since day one, 13 years ago, we have been on the cloud. I've never used off-the-shelf software. I don't have a Bloomberg terminal. Everything we've done is not like a screen investment. Here, so on July 1, we launched another strategy, which is why I'm out marketing. You can see here, since July 1, we've handily beat every major market benchmark. This is on a net basis, management performance fee. And then, more importantly, our performance statistics. So you can see our Sharpe ratio, again, handily beats the benchmarks. This is actual data. Our alpha over index, which is beta adjusted. And then our correlation index, you can see, based on every index, is really low. The one thing I really want to point out, though, especially to the allocators and investors in the room, is our R squared. So if you're not familiar with what R squared is, I'll use a hypothetical. If we had an R squared of 1 on the S&P 500, then that would mean 100% of our return is coming from the S&P 500. But you can see here, our R squared is 0.24, which means about 24 cents of every dollar of our return is coming from the S&P 500. As an investor, you really want to focus on, you're essentially investing into the algorithm. And what this highlights is that our algorithm is the source of the majority of our returns. So before I talk about how we're using technology in our operations investing, I think it's instructive just to define this. So how we're using technology is mimicking human intelligence, effort, and decision making. And there are two broad categories for that. One is automating tasks, and then the other one is generating insights. And those are the two examples I'll go through. So in terms of using operations at global return, AI does do a great job at repetitive tasks. However, what it's not good at doing is critical thinking, what we know is like second level thinking. And this is a great example. This picture you can see here. What I did is I went to an AI software program and I typed in some keywords related to operations, AI, one click, and you can see it got this finger, one click. But if you look closely, there's actually misspellings. And you can see here, actually, I don't even know what these two words are, but AI did not do a good job of creative thinking to generate this image. How we're using AI in our operations, I call it one-click operations. You can see here are some examples. The benefits are obviously we're saving time. Once you build the software code, it's one and done. Unless you want to make tiny tweaks to it or you want to change something, you don't ever have to look at that again. And it's a great way to save time, energy, money, effort in executing mundane daily or weekly or monthly tasks. But what we're all here for is how are we going to use technology to find that ever elusive alpha?
Right now, what's hot is AI and SpaceX.
So like I said before, AI and technology is excellent at processing large amounts of data very quickly and accurately. The days of downloading an Excel spreadsheet from Bloomberg to figure out what stock you want are over. I just got a 5-minute warning, so I'm going to go a little more quickly here. This is it. So let me just, all right, I'm going to go through these two examples here on how we're using technology to extract, transform, load data, which is about 80% of portfolio managers' time, and then risk management. So this is our investment process. We have APIs directly to the SEC. We're using a data called XBRL. Most people haven't heard of that. If you haven't heard of it, don't be afraid. You can ask me more about it later. But we have APIs going directly to the SEC, where we're pulling this data, we're putting it into our database, and then we're conducting, you can see in step 5, we're conducting a lot of calculations based on statistical analysis and proprietary factors. We're doing this for the entire Russell 3000, and it takes about 20 seconds. That's the value of technology. Before fully integrating this 13 years ago, it might take 2 weeks to do this, to actually download a 10K, a 10Q, read them, put them in an Excel spreadsheet, analyze them. For one stock, 2 weeks. Today, we're doing all 3,000 in about 20 seconds. The second half of our step is what you can see here. This is taking about 10 seconds. That's based on our proprietary factors. It's producing a potential purchase stock list, running some calculations. RRR stands for risk reward ratios, which is how we evaluate investments. And then we have a buy and sell list that's created. So here's an example. We're all familiar with Fox Corporation. The algorithm identified this enter price, exit for loss, exit for a profit, for return potential of 17%. We look at everything in terms of how it impacts the fund. So if we were going to take a loss on this investment, it would have cost the fund about 8 basis points. A return would have been about 42 basis points. Contribution to the fund, and then we have a risk reward ratio of 0.19. So you can look at that risk reward ratio as we're risking 19 cents to make $1. That's all that is, risking 19 cents to make $1. So we made the investment. You can see we made 19% over the same period of time. The S&P 500 and Russell did not. They went up, but not nearly as much. How we're using AI in risk management is essentially, I'm going to think about like 1 minute left. So again, I'm going to race through this, is in planning, detecting, and responding. Obviously, part of the planning is identifying anomalies, correlations, so you can invest in your risk factors or avoid investing in your risk factors. And then predictive analytics is self-explanatory. And then real-time analysis and trading responding. So literally right now, and I'm willing to do it for anybody that'd like to see it, I can open up my laptop and I can look exactly at our portfolio, and I can have a probability analysis, risk analysis, and then obviously trade execution. So I'll leave you with these three takeaways. AI is a very, very powerful tool. I think it feels a little like ESG 5 years ago. A lot more people are talking about it than actually doing it. I do sense it's a buzzword more than it is actually being used in investment process. But it's a powerful tool that does enhance operations. It's a game-changing advantage, and I think there are some fund managers that have the data to support that it does increase return and can increase and can reduce risk, and it's here to stay. So fund managers need to adapt it. And then I had AI write this last sentence. The future of alternative investing is in smart technology, but importantly, smart managers who understand how to build that technology. All right, that was quick. I'm around for the rest of the day.
Over here, we're gonna run a panel.
Okay.
Take your laptop with you.
Excellent stuff. Great. Kai, you ready to join? Great. So do we all have to be like Spock going forward? Computer, I meant this, right? Fantastic. Great. Yeah, just hit a microphone that works. Just hit the button to turn it on. Make it green.
Yeah, it's green.
Hello.
Fantastic.
Yeah, we all want
Isn't
green.
that the theme of today, right? Our first speaker was talking about green. So again, thanks so much for turning out today. And again, we're gonna have Alan Patrick off tomorrow, and I hope that everybody turns out for him. It's gonna be a book signing. We're gonna give away some books. It's gonna be a lot of fun. So let's talk about AI in alternative investments. I was hoping that Kai could introduce himself and tell us about what he's doing, his background. And before that happens, I do want to say for Elliot that if you're looking to raise capital, you really should hire an Ivy League graduate, because that's what they're all about. I mean, if they don't have a network, then they're useless. Fire them, get the next guy. And that's been Pantera's philosophy for years. You just hire a guy in charge of marketing. If he doesn't do anything, fire him, go to the next one. Just keep on rolling. That's how it works. That's a real world. So anyway, Kai, introduce yourself.
Yeah, so I'm Kai Wu. So I am an Ivy League graduate, not so good at marketing though. So that didn't rub off. But so I went to Harvard, studied economics there, wrote my thesis on predicting financial crises with Ken Rogoff. From there, got my first job at GMO, working for Jeremy Grantham, who's obviously very famous for spotting bubbles. But kind of the main lesson I learned there was actually, if you go back to the history of his firm, when I was there were $150 billion in assets. And the way he had built it was by being really early and applying technology into markets. So he started off with his two partners in the 70s as a traditional stock picker, just reading through the 10Ks, and kind of came upon an insight that, hey, maybe what I'm doing can be automated. And he went down to the Baker Library at Harvard and dusted off all those documents, put it into a computer, and found out that, hey, guess what? Like, what I'm doing can be done even more efficiently and effectively just by models. He had effectively invented the first factor model. He then took that from the US into small caps, international emerging markets, and then eventually full asset classes. So I think the lesson there is, you want to be an early adopter in technology. That's how you can get an edge in what we're doing. And it'll tie back into AI in a second. So I left GMO to kind of pursue my own entrepreneurial itch. Spent about 6 months doing crypto arbitrage strategies. This is where I met my friend Mitchell. And then kind of went back into traditional finance as a co-founder on a hedge fund, again in Boston, kind of systematic strategy. I sold out my stake there and left to build out my own firm in 2018, and that's Sparkline Capital. So I'm the founder and chief investment officer here. And so kind of the question I guess I get a lot is like, what is the reason for doing this yourself? Like, why are you kind of so passionate about building out, your own kind of platform? And I think it comes down to this, which is, so value investing, which is the school that I come from, that goes back to, say, Warren Buffett, then back to Ben Graham, who wrote Security Analysis in the 30s. I feel like a lot has changed in the world since, that book was written. Obviously, the economy 100 years ago was mainly industrial. And you kind of fast forward to today, and it's, information-based. Our largest companies are not railroads, they are tech companies. Yet I feel like a lot of the kind of more kind of quantitative value investors are still very rooted upon this idea of like price to book ratios, trailing earnings metrics, things that, may have made a lot of sense in an industrial world, but for like an asset light business, like a technology firm or a consumer brand, not really that meaningful. And so it's not really a surprise that, say Russell 1000 value has underperformed its growth counterpart now for 15 years straight. And that's led people to say, hey, value investing is dead. We should just kind of completely abandon this, buy some meme stocks. And of course, that's not what I believe. What I believe is that, value investing is kind of first principles, like the thing you're supposed to be doing. You want to buy cheap stocks relative to intrinsic value. It's just a matter of defining what is value. How can we kind of expand it from not just tangible to intangible assets? So, the whole premise of what I've been working on is how do we quantify intangible assets? And what that means to me is, we have kind of a framework where we have 4 different categories of intangibles. We have intellectual property, human capital, brand equity, network effects. So those are kind of the 4 broad categories, of which, of course, there are many, many things you can use. And so we want to be able to figure out ways to add these things into a more holistic measure of value. But how do you actually go about doing that, right? So the first thing we said, why don't we just take the 10Ks, the accounting statements, and capitalize historical, say, R&D and marketing dollars? And you can do that, but it doesn't work for a variety of reasons. And so then we said, what's the next step? What can we do instead? And so, of course, we're very lucky that we live in this age of big data, and there's been a massive explosion of information out there. We started looking at unstructured data in particular. That includes like patent abstracts, trademarks, LinkedIn, Glassdoor, job postings, earnings call transcripts, news, social media. So obviously, there's a ton of information contained within these data sets as to the strength of a brand, the strength of talent. The challenge, of course, then became how do you actually unlock that? Because you open up we had the IP lawyer initially, right? You open up a patent abstract, and it's not something you can throw through a linear regression. What you need instead is a way of a specialized tool to process this unstructured data. And again, we're very lucky because around the time I was founding my firm was when the BERT model, so the original transformer model, was published by Google. And so we actually started training our own large language models, using it as a way to take these large, kind of messy natural language documents and creating structured factors that we could then use alongside more traditional metrics in a kind of value style portfolio. So looking for stocks not just with cheap, price to book, but cheap price to patents and so on and so forth. And so, obviously since then, technology's evolved a lot. And so we're not training our own LLMs anymore. Obviously, we can just leverage the models created by, the large platforms like OpenAI, Anthropic. And I think that's very interesting. It opens up a, pretty cool opportunity, which is that, for investors, not just myself, who are quants, by training, there are now, there's the access to these tools are kind of democratized. And you're, seeing a lot of interesting innovation in fintechs and smaller funds, as well as larger ones, with regards to how these tools can be applied to the investment process. And I think, Elliot touched upon some of them. And I just feel like there's it's a very exciting time to be working in the space.
So Kai, I went to AI to ask you questions, and you just answered all the first 5 ones that.
Sorry about that.
So I still have more questions. So this is in a hedge fund structure that you have this right now, or?
So I actually run 3 funds currently. I have 2 funds that are actually exchange traded funds, ETFs, and they're listed on the New York Stock Exchange. So you go on Robinhood, you can buy a few shares if you want to. And those are focused on US large mid-cap equities. That fund's been around for 3.5 years. And we launched a second fund that focuses on development market international. And we're very lucky. We launched it towards the end of last year. It's been on a pretty nice tear the past few months. And we also have a separate product that is a fund that owns small cap crypto, so long tail cryptocurrencies, liquid assets in a private fund structure. And it's a hedge fund, but it's long only. But the key here is that we're using the same principles to invest in both equities and crypto. I mean, there's really no reason why they should be different. Looking for kind of cheap assets relative to intangibles, whether it's network effects or human capital brand. And those assets are relevant whether you're a stock or you're a crypto token. And we've just structured it differently because of course, like many of the regulatory issues that were discussed in the last panel.
So there's numerous examples of AI going wrong. I think there was a bunch of real estate firms that are using AI to buy assets and this went south. And then there's other examples in the hedge fund business. But ultimately, a lot of the rationale for why it went wrong was because people ignored the AI signal and they went with their instinct instead. So can you guys, talk about that and the desire to become fully automated versus, are you really using AI to do everything, or are you using AI, but you're monitoring it and you're pressing, you're doing a single click at one point or another?
I use the analogy of flying a plane. Everybody knows that a pilot is not actually holding the controls for the entire duration of flight. They're there during the most important points, which is takeoff and landing. And that's how we're using technology. So I am always looking over the portfolio, and I will make adjustments. For example, like a pilot during takeoff and landing. The difference there, though, is an adjustment that I make will ultimately be integrated into the actual code. So, for example, this hasn't happened since launching this strategy in July, but if there was a COVID type example that were to pop up, that was not written into the code because nobody could have predicted COVID. The signals haven't been written into the code, but with that past experience, it would be. And I found that investors actually want to know that the code is being improved over time.
Kai?
Yeah, so I actually wrote a paper last year. It's on my website if you want to look at it. It's called AI Financial Analysts. And it kind of covers this topic, which is, if you want to step back and say, what is the job of like a hedge fund or a portfolio manager? And you kind of break out and unbundle all the different tasks. Right. In a very simple stylized way, you can say there's two kind of primary roles on the investment side. There's a portfolio manager, whose job is to kind of come up with a creative strategy, direct the research agenda, so on and so forth. And then the analyst. And the analyst's job is to kind of gather data, so read through all the filings, all the news, kind of stay on top of all the executive comings and goings, and then synthesize that into reports that they kind of push up the flagpole to their boss. Right. That's a very stylized model. Of course, all firms are different. But when it comes down to the question of what is AI good at, you really have to ask that in context with what are humans good at, right? Because obviously, humans have strengths, AIs have strengths, and in some ways they're in competition, but in more than that, they tend to be actually complementary. And when I spent a long time on this paper, just kind of going through task by task using like the government database that kind of decomposes jobs. What are the things that AIs are good at? What are humans good at? And it's pretty intuitive, right? We're good at creative thinking. We being humans, of course, I'm not a robot. Creative thinking, relating to people, and whereas machines are more efficient at kind of going through repetitive low-end tasks, as Elliot was saying, rapidly, without complaining, and very cheaply. But you try giving it too much, rope. Oh, hey, so I'm going to ask you a really complicated question now. So which stock should I buy? That's when things start to go off the rails. So at least I can tell you for myself, what I've determined is that the killer app of AI, or natural language processing, LLMs, is the ingestion of unstructured data in an efficient way. And so that's where I have my eyes pointed. And then from there, you generate kind of factors. I'm a quant, so I take factors and then build portfolios. If I were a fundamental PM, I would ask it to create reports, which I then read and kind of apply my own thought process to. And so by narrowly scoping AI to that one lane, you kind of keep it contained and can avoid catastrophic errors where it could potentially hallucinate. We all know many of the downfalls and pitfalls of things like ChatGPT.
I want to add to that too. So there are two types of data. There's structured data and there's unstructured data. Structured data is the same whether you speak English or Chinese, whether you live in China or America. It's the exact same data. Unstructured data is that sort of it's not structured, but it also oftentimes requires second level thinking to understand and grasp, and is much more difficult to quantify and qualify. And I'll go back to the COVID example. So in 2020, we generated a 52% net return, and we had a 50% net market exposure the entire year and 25% in cash the entire year. SS&C is our administrator, Eisner Amper's our auditor. Our algo could not have performed that well using structured data. It required second level thinking. It required critical thinking skills that just you're not going to get from structured data or structured algo.
Great. So I got a quick question here. So I'm maybe you guys are familiar with the book by Peter Thiel, 0 to 1, right? So my question is there more money investing in AI in terms of its ability to refine a strategy, to bet against somebody else's strategy, and likelihood they're going to make a mistake, or is there are there green fields out there, like unstructured data, et cetera, where there's whole strategies that haven't been explored that can be explored? Any thoughts? Hi.
I mean, I've tried it both ways. So again, I'm a quant, so I have a wealth of kind of historical data you can use to backtest. And so I did two things. Okay, so the first thing I did was I focused on this library of different alphas. Think of it like price momentum, various financial ratios, kind of the more standard things, like nothing crazy, nothing revolutionary there. And I asked the question, which is, all right, so right now, let's imagine as a starting point, as a base case, right, as a control, we just use a linear regression on past returns to kind of figure out which things have historically done well and, weight them accordingly. It's a very simple portfolio construction thing, like quant finance 101. All right. And then I said, all right, what if we instead were to use a deep learning model? So not the kind of full blown large language models we use today, because this paper came out in 2020. But what if we use like a not linear regression, like a 2-layer neural network or a 3-layer network or 4 or 5? And what's really interesting is in machine learning, right, there's this idea of like over and under fitting, which is you want the data to be the same size as the model, right? If you have a very big model, in theory, you can kind of capture more nuance, interactions, nonlinearities in the data. But the problem is that if you have too few data points, you overfit and it doesn't work out a sample, right? Conversely, you can have a very simple model, right, like a binary classification, where your risk is actually underfitting because you're not able to capture the kind of complexities of the information. So there's this kind of trade-off, right? And what was really interesting was when I actually ran this analysis and said, over this particular data set, right, if I were to use a simple model, a medium model, or a complex model, what would be the best out of sample? And it turns out that there's a kind of optimal point, like almost an upside down U curve, right, where the results are optimized. And that's a kind of medium complexity model, which is great. And, there's a bit more juice that can be squeezed out of, traditional quant models by applying machine learning. And again, this is not a high frequency, this is a medium frequency trading. But the thing is that, compared to, say Llama 2, which has 15 trillion parameters, right, this thing is a joke. It has, maybe 100,000. And so the point being there is that these models start to overfit at even very low complexities, right? You think about what is, finance as a quant. We all like to say we have big data. We don't really, because, we have 5,000 stocks. And if you trade on a lower frequency, you have, let's say, 1 year intervals, you now have, 100,000 data points, right? Compared to 15 trillion. That's not that much. Finance data is very noisy. It's very non-stationary. And so, the point, I guess what I'm trying to say here is that if you're trying to, improve and refine traditional quant models, it is a step forward, but it's not a game changer. So now, what is a game changer is the other approach, which is to say, I'm not going to use these fancy models to predict future returns. That's just not going to make sense. It's just too noisy. Let me instead use it as a way of ingesting unstructured data to take, what is 90% of data out there that's not being used by most investors, right? Most investors are focused on the structured numbers in the Excel spreadsheets. Let me take all this information and now bring it into the investment process, right? That is, I think, a game changer. And these models have, gotten better and better over time. And you don't have the same pitfalls, right? Because natural language doesn't change the same way that markets do. If I discover an anomaly in financial markets, it'll be arbitraged away in a year. Whereas, the definition of a cat is going to be the same thing as a cat in 10 years, right? These things are much more stable, and they don't have the same risk of overfitting. And by the way, you can train them on all of Wikipedia, all the internet, all books, ever created in the English language. And so you actually have enough data now in order to kind of have it understand natural language. Whereas in financial markets, you're limited to, again, 5,000 stocks over 50 years, which is not going to be sufficient to train a model.
So let me ask a question, because, from a big data point of view, in theory, you can download every trading position of every firm ever that is still in existence, and also get granted as to get down to the trader maybe. Is there any value in having that kind of data as a predictive model to see how somebody's going to trade against the position that you create, or no?
So I mean, I have a view here. I mean, I think that we were talking about this this morning, which is that over time, I believe that a lot of the foundational models are becoming commoditized. So you think about GPT-4, it came out a few years ago. It was by far better than anything else. But over time, we've seen the convergence where we have 3 or 4 models that are about the same. DeepSeek came out, which is not quite as good, but it's a lot cheaper. So in some ways, it's better. The point being that, like, the future that I envision is one where, like, the edge is not so much in having a bigger or better model, because they're all just being trained in the same public data sets, the internet, Wikipedia, etc. Where you can get an edge is actually a proprietary data set. Like if you're training on information that no one else has. So, if someone was talking about Ken Griffin, if I were Ken Griffin, that'd be pretty cool because I'd be rich, but also I could, train these models on all the trading history that I've ever, had over the course of time. Obviously I work for a startup, so that's not really an option. But I'd obviously be very curious if to see as these larger firms kind of develop this technology, if it does create a kind of network effect, a bit of a moat, giving them advantages down the line.
I think the question you have to ask to become Ken Griffin is how do you achieve structural alpha, right? Because he has structural alpha. It's not a trading strategy.
You're 100% right. And Kai actually alluded to that earlier, and I talked about it in my presentation, which is it's processes and procedures. Getting the human out of the way in terms of investment process and procedures and replicating this and automating this is, I think, the structural alpha. Or one of the things I love about how I've set up Global Return is I can look in our actual flow chart and see, oh, there's a bottleneck here, or there's an issue here, and go back and rewire just that little portion to smooth out that structural alpha. And then I'll add one more thing. I think the other thing too that's really key here in generating better returns is managing the risk. And AI and technologies is the value there is you can write the code before it happens, unless it's an example like COVID.
Right. So I always tell people, when they present their fund, the best way to present a fund is to say, not that, we did this, we regressed the model, we blah, 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 but rather to say, I think this is where the future is and we're going to be there. Do you want to join me on the journey? Because, a lot of people don't really think that way. They're like, oh yeah, I have to have, some kind of a marker down on the future, right? So could you guys express in the best way possible where you're going to be in the future and why people should place a marker on you guys? Why don't you start on Elliot?
Okay, thank you. I'm from a town of 5,000 people that had no stoplights and was surrounded by cornfields. I'm not an Ivy League grad. I moved to New York. I didn't know a single person. And I had no financial assistance, no financial support. I came here to pursue my dream. Today, it's not an overstatement to say that my LPs are literally some of the most reputable people in the world. I have a board of advisors that would make most people in the industry melt.
So this is qualification. We're not interested in that. You're credible because
People
you're
like
here,
me.
right? He's credible because he's here, right? Where are you going to be in the future? That is why the journey that we should go on.
The answer to that is, as far as I've come, I'm just getting started. And our data indicates that as we bring in more clients, as we bring in more capital, I will continue to build out our operations, and we're just getting started.
Kai?
Yeah, I mean, I think I kind of already touched upon it, which is, I think the big opportunity today is to find a way to use AI. I mean, everyone's looking to figure out how AI can make investors better, right? Everyone, that's why you're listening to this talk. I think for me, like I started talking about this in 2019, 2020, and I've basically been on this trajectory building this out over the past 5 years, which is I really think the opportunity lies in unstructured data. It lies in taking the 90% plus of information out there that, fundamental investors are looking at, but not systematically. Quant investors are not looking at because it doesn't fit into the econometric toolkit, and bringing it into the process. And there's just so much more that can be done. Like, I'm kind of a very active researcher, and I publish a lot of papers. I, again, encourage you to come to my website. I'm very transparent about the stuff I work on. And so I think the idea would be that as time rolls on, to continue to uncover new ways, new data sets and new things that can bring into the investment process. I like to talk about it. To kind of continue to move the academic literature forward and the kind of the research community forward, and then to launch more products as well as improve the existing ones. I mentioned I launched a fund last quarter. We filed for 2 more funds, one that focuses on U.S. small caps, one that focuses on emerging market stocks with the SEC. So they're kind of sitting there ready to go live. And so, yeah, the idea would be to continue to launch more products, provide our, clients with the ability to build out a global portfolio, utilizing intangible value, which is kind of the brand, across stocks and eventually across crypto as
Okay,
well.
we have a question in the audience.
I have a question for Elliot. Elliot, a great presentation. I enjoyed watching that software. My question have two parts. Out of your senior analysts, how many of them are proficient as you are in operating that same software? And then during first meetings, most of us here are allocators, family office, or whatever, advisors. How many of us during our first meeting is interested in the technology? Your experience.
My experience is very, very, very few people are interested in the technology. And the reason, at least in my experience, is because all of my clients and LPs have been word of mouth. The phone rings and they say, "Hi, Jim gave me your name and number. He said you're a good investor, you generate good returns. I'd like to invest." And so that historically has been my sales cycle. They don't care. Again, I'll say XBRL. Nobody in this room's heard of that, and that's actually our data. That's the data we use. We did a communication session where I was being coached on effective communications, and I was told, don't get into the weeds with data and technology.
What's that?
Because people's eyes gloss over. If they like you and it was a good referral and you put up good numbers with low risk, it's a high probability investor.
Did you use Shelley for that session or?
No.
I highly recommend her. Kai?
And your question was around analysts or?
How can the investor that a lot of what you said probably is not part of our due diligence when we meet some emerging or veteran, active or but it's all about the initial due diligence that we conduct. Your experience, the size of the team, education of your analysts, because at the end of the day, the analysts are the ones to extrapolate that data, scrub it or not scrub, and conclusion to it.
Yeah,
Kai?
I
I think that question was for Kai.
No.
I just want to address that part too. In our roles, the title might be more specific, or the better title might be computer scientist. Because I don't have an analyst, I have a computer scientist who actually knows Python code better than I do, but I have a much deeper understanding of the accounting and the investment process and other factors that I'm looking for. So as you're doing due diligence, you would want to be focusing more on a computer science.
We're in lightning round. We got to get 60-second answers. Kai?
So I think it was a Paul Graham, one of the guys at Y Combinator, said something along the lines of, we're going to see the first $1 billion unicorn, right, with AI. And I think that's very much in line with my vision as well, which is, why have human financial analysts if your AIs can do as well, can do the same thing, cheaper and quicker. And so to the extent where I've been building my business out, it's been actually not, it's been very explicit not to hire human talent in that role, because I think that's one area where technology can serve. And so I think just, when diligencing, funds and emerging managers, I think it is worth thinking a little bit about how structures may be different today than they were maybe several years ago. And just kind of being open-minded with regards to the set of different firms.
60 seconds are up. Next question.
Hi, a couple of questions actually for Kai. So one is talking about quantity of data for training. In finance, regimes change. And so the old data becomes irrelevant, except for anticipation of maybe that regime coming back. But the regimes are cyclical. Sometimes they last long times, most of the time they don't. And they're actually shortening. So you don't need so much data, to be honest.
Question, please.
Yeah, so the question is, why can't AI be used to on such a shorter time window?
And was there a second question that you can say in 5 seconds?
Let's go with this one.
Okay, great. And hand that mic to Mitch.
Yeah, so I think your question is to the extent where one's belief is that investing is basically just a one-dimensional game. It's risk on, risk off, or growth regime, value regime. Can AI be used to predict that? I would be skeptical of that. I just think that, there just isn't enough data to train on it. Over the past century, we've probably gone through 5 value versus growth regimes. And so just that's not enough data points to utilize AI in a predictive way. I think you were kind of going a different way in the last part of the question, which you were saying, what about high frequency? I think that high frequency data is very useful fodder for AI. And on the execution side, I do know people who are effectively using it, again, on a matter of seconds and nanoseconds. I'm more talking about from my personal experience trading in mid to long frequency strategies, trying to build fundamental investment processes where it does require kind of a research process that includes not just pure backward looking data mining, but also human intuition and guidance.
Okay, great. Mitch?
Hi, Mitchell. So you have a crypto fund and other funds. Is a crypto fund outperform? My theory is that there's more unstructured data in crypto and it's newer, it's more dynamic. Is that hypothesis valid or not?
Yeah, so we measure the fund internally against an index of altcoins. And so against that, we have an information ratio of 1.4. So it's outperformed considerably with high consistency. We have not beat Bitcoin, though.
Okay, next question.
Yeah, Kai, are you currently managing an actual ETF, a non-crypto style ETF? And if you are, do you have automatic rebalancing during the year, or is this voluntarily done?
Yeah, so we manage 2 ETFs. And kind of to the question of this gentleman around how do you build a firm, what we've done is we've outsourced the operations to a $14 billion white label provider. So they do all the trading and execution and some other legal things, so we can focus on the research. We rebalance on a roughly monthly frequency. So each month we'll send them a trade file saying, hey, here are the new positions. We just did this actually a couple of days ago. So now rebalance to these things. But again, because of their value strategies, they're not super high turnover. And so, the portfolio might completely change once every, say, 15 months. So it's not super latency sensitive.
Great, fantastic. So I do have, there's no other questions. I have one closing question, which is in 60 seconds or less, name a signal you got from AI that you used to make money that was successful, and another signal that you ignored that would turn out to be successful, but you ignored it and made a mistake. Elliot, why don't you start off?
Well, a reference example that I gave about with Fox. I mean, we bought Fox stock, and over a short period of time, maybe 60 days, it went up 19%, added 42 basis points to the fund, while over the same period of time, the S&P 500 made 4%, and the Russell 3000, I think, was less than that. We do keep really low risk, so yeah, I mean, there are times, when we take a loss. So I don't know if I answered that, but
okay.
I think the case study in NVIDIA, which is everyone's favorite stock, is instructive here. One of the signals we look at is patents, and we have looked at it since 1790 when the first one came out. We use AI to kind of create clusters of technologies that we think are cutting edge and emerging, and then we figure out which companies are having exposure to those things. That was a signal that, of course, flagged NVIDIA. The fund was long in 2021, which was unheard of as a value strategy. The Wall Street Journal even wrote us up about this. That you're going to buy a stock with a 100 PE ratio because you think that it's actually cheap relative to this IP intangible that you've created. So that was great. And then the problem is that we're value managers, which means that we care not just about how much IP the company has, but what the price is relative to that. And so it goes up like 3x. And then at some point we're like, all right, well, we're value investors, it's time to get out. When I say we, I mean the models. And so we sold way too early and then doubled again. So that's kind of the sad ending of the story, which is, of course, like everyone else, we wish we held longer.
Fantastic. What a great story. Well, thanks so much, guys. Thanks